Today, we're diving into a really radical idea from trader Tom Hougaard's book, Best Loser Wins. And the core idea is pretty counterintuitive, but it's incredibly powerful. To actually win in the markets, you first have to get exceptionally good at losing. I know, it sounds like a total paradox, so let's unpack it. Okay, first, let's start with a really sobering fact. In Europe, brokers are legally required to tell you how many of their clients lose money. And that number? It's consistently hovering right around 80%. That's just a staggering failure rate. 8 out of every 10 people who try this fail.
And that right there brings us to the central puzzle we're going to try and solve today. I mean, with all the incredible advantages modern traders have at their fingertips, how can that failure rate still be so ridiculously high?
This is what we call the trader's paradox. And to really get to the bottom of it, we need to take a look at what's in the modern trader's toolbox. You know, on paper, traders today have never had it so good. I mean, look at this stuff. We're talking about the lowest spreads in history, insanely powerful trading tools, news from all over the world in an instant, and yet, that 80% failure rate, it just doesn't move. So if it's not the tools, what is it?
Well, the problem isn't external. It's not the market. It's not your broker. It's not the charts. According to Tom Hougaard, the biggest enemy a trader will ever face is staring back at them in the mirror. It's their own brain.
Here's where it all goes wrong. Our brains are basically wired for what you could call supermarket logic, right? If you see chicken is 50% off, you think, wow, what a bargain, I should stock up. But if you apply that same logic to the financial markets, it's an absolute catastrophe. A stock that's 50% off isn't a bargain. It's a massive, flashing red danger signal. Hougaard tells this crazy story about the Marconi stock collapse. As the price was just plummeting from over 1,200 pence, clients kept buying more and more because in their minds, it was cheap. They were using that supermarket logic, and they lost every penny when the stock eventually went to zero. They just couldn't resist what they thought was a good deal. And this really shows us that spending all your time hunting for the perfect strategy is, well, it's a distraction. The real reason 80% of traders fail is because the very instincts that help us survive in our daily lives are actively working against us in the market. Our instincts are wild for failure. And look, this isn't just a nice theory. There was an incredible analysis done on millions of trades that exposes this mental flaw with cold, hard data. The data really doesn't lie. Okay, get ready for this, because it's wild. A major FX broker analyzed 43 million real trades from its clients, and the results are absolutely stunning. Just look at that win rate, 62%. The average retail trader was profitable on more than 6 out of every 10 trades they made. They were right more often than they were wrong. So, here's the billion-dollar question. If they're so good at picking winning trades, how on earth are they still losing money? It just doesn't seem to add up. Well, the answer is in the size of their wins versus their losses, because their average loss was almost double their average win. Why? It all comes down to a complete reversal of emotion. When a trade goes against them, they get hopeful. They cling to the hope that it'll turn around, and they let that loss get bigger and bigger. But the very second a trade is in profit, they get gripped by fear, the fear of that profit vanishing. So they snatch it and close the trade way too early. They are hopeful when they should be disciplined, and they are fearful when they should be patient. This is captured perfectly in a story about Dr. David Paul, who's a brilliant inventor. He created the super sophisticated program, and one day his program, and every expert he knew, was screaming that the market was about to have a huge rally. So, feeling confident, he placed a massive buy order. But the market started to drop, so he bought more, convinced it was just a temporary dip. He was trading his opinion, not the market. And then his wife, who knew nothing about trading, just walked past, glanced at a screen and said this one simple, brutally objective thing, but it is not moving up right now, is it? And that one innocent question just shattered his bias. He realized he wasn't trading the market, he was trading his ego. This mental trap that he fell into, it has a name. It's called cognitive dissonance. It's that awful, grinding feeling you get when reality, my trade is losing, conflicts with your belief. My analysis said it would win. And to stop that mental pain, we do completely irrational things, like holding on to a loser, just hoping it will come back and prove we were right all along.
So, if the problem is literally our own human nature, what's the solution? Well, it requires a complete, radical shift in how you think about trading. And this brings us right back to the core philosophy of the book. The path to winning isn't about becoming a better winner. It's about becoming an exceptional loser. So what does best loser wins actually mean in practice? It means you have to condition your mind to take a loss quickly, without emotion, and without any anxiety. Your success as a trader isn't defined by your winning trades. It's defined entirely by how you handle your losing ones. It's all about your relationship with pain. This means you have to flip your natural instincts completely upside down. You have to train yourself to become comfortable with your winners, to let them run, and at the same time, become deeply, profoundly uncomfortable with your losers, cutting them loose immediately and without hesitation. Okay, so how do you actually do this? How do you rewire your brain to fight against its own self-sabotaging instincts? Well, here's a 4-step process for rewiring your brain. First, you have to accept risk unemotionally. That means setting your stop loss before you enter the trade and truly, genuinely accepting that outcome. Second, you have to detach from the outcome. Think like Tiger Woods. He forgets the last shot, whether it was good or bad, and focuses only on this one. Third, analyze your behavior, not just the charts. Ask why you exited a trade, not just what the market did. Were you scared, gritty? And finally, you have to actively control your mind. This is a workout. You have to intentionally train your brain to stay calm under pressure. You know, the legendary pit trader Charlie D really put it best. The entire game, all of it, comes down to this: fighting the very emotions that are hardwired into our DNA. It isn't about being smarter than everyone else. It's about being more disciplined than your own instincts. So we end with this final thought. You now have the blueprint. You know what you need to do. The only question left, the one you have to ask yourself is, are you actually willing to fight your own human nature to do it?